All right, let's dive right into this. Welcome to The Explainer. Today, we're taking something that, let's be honest, usually puts people straight to sleep, the accounting cycle, and we're going to bring it to life. We're going to absolutely master this cycle, and we're doing it by stepping directly into the shoes of a business owner. Specifically, you are the proud owner of Rough Times. It's a highly lucrative, totally essential gossip tabloid dedicated entirely to the drama of our furry friends at the dog park. I mean, it's serious business, right? And serious business requires some serious accounting to keep track of all that success. So, here's our roadmap for today. We're going to hit Welcome to Financial Accounting, the double entry rule, organizing your data, the accrual method, generating financial statements, and finally, closing the books. Don't worry about any of the jargon. It's really just a logical, predictable, step-by-step loop. Let's kick things off with step 1. Welcome to Financial Accounting. Okay, placing you straight into the owner's chair at Rough Times, we're going to see exactly how this works on a day-to-day basis. Now, the formal textbook definition of financial accounting can honestly sound like a bit of a mouthful. The process of identifying, recording, summarizing, and analyzing an entity's financial transactions to report them in financial statements. Yikes, right? But let's strip away that intimidation factor. Really, it's just a simple, structured process of tracking your daily business transactions so you can actually create useful reports at the end of the year. You identify what happened, you write it down, and you summarize it. Easy. And boom, here is the inciting incident for our story today. It's March, and you decide to run this massive promotional offer for annual subscriptions to Rough Times. These subscriptions are going to begin on April 1st. Well, it turns out people literally cannot get enough of the local dog park drama, and you end up netting $40,000 in brand new subscriptions. Best part? All paid for in cash, up front. Now, the very first step in financial accounting is simply identifying this transaction. You just made 40 grand. Moving right along to section 2, the double entry rule. So now that we've identified that massive $40,000 cash influx, we've got to look at the mechanics of exactly how we record it in our books, which brings us to a really crucial question. What exactly is double entry accounting? Look, Rough Times is a serious enterprise now. We can't just scribble this kind of income on the back of a napkin. We need a real system. Double entry just means that every single transaction affects at least 2 accounts. There are equal and opposite sides to literally everything we record. But, why do we actually do it this way? Well, it all anchors on one absolutely unbreakable rule, the accounting equation. Assets equals liabilities plus equity. This one simple formula totally revolutionized how we record transactions. It basically dictates that the stuff a business owns must always equal the stuff it owes. Because this equation is a universal truth in accounting, it has to always balance, no exceptions. To break that down a bit more, on the left side, we have assets. These are your valuable resources for the future, like, that giant pile of cash you just collected. On the right side, we have liabilities and equity. These essentially describe exactly how you paid for those assets. Liabilities are the obligations you owe to third parties, think lenders or suppliers. Equity, on the other hand, is your claim as the owner on the business. So every single time some economic benefit flows into your business, we use these things called debits and credits to track exactly where it came from and exactly where it went. And this brilliantly illustrates how that equation balances out every single time. Let's actually put this into practice by creating a journal entry for our big March promotion. To record our $40,000, we place a debit on the left side to our cash account. That increases our assets. Then we need an equal and opposite entry to keep our equation perfectly balanced, right? So we credit subscription revenue for $40,000 to record our income. As you can see, our total debits exactly equal our total credits. Perfect, beautiful balance. All right, on to section 3, organizing your financial data. Okay, so we've written down our journal entry, but now we have to ask, where do all these individual little entries actually live once we've recorded them? Well, they live in the general ledger. Back in the day, this literally used to be a massive, physically heavy book. But today, obviously, modern accounting software just treats the general ledger like a giant central database. It stores a complete record of 6 main types of accounts. We've got assets, liabilities, and equity, which we already know from our golden equation, plus revenue, expenses, and withdrawals, which are sometimes called dividends. And those last 3, they actually feed right back into the equity part of your equation. It's all connected. A really handy way to visualize these accounts is by using T accounts. Just picture a giant T. Debits are always recorded on the left side, and credits are always on the right. If you post your journal entries into these T accounts, along with all your other daily transactions throughout the year, you might eventually look at your ledger and see your rough times cash balance sitting at a nice accumulated $48,000 on the left side, while your subscription revenue totals say $75,000 on the right.
Now let's fast forward a bit. It's December 31st, the very end of the financial year. We need to run what's called an unadjusted trial balance. This is basically just a big list summarizing all our accounts and their closing balances. The word trial here simply means test. We are testing to ensure that at the very bottom of this list, our total debits exactly equal our total credits. If they match, awesome, we're doing great. But notice we call it an unadjusted trial balance, and that little word is a huge hint for our next absolutely crucial step.
Which brings us to Section 4, the accrual method. Here's the thing. Rough Times can't just do whatever it wants. Businesses actually need to follow standard accounting rulebooks, like IFRS or GAAP, to make sure their financial statements show a true, fair view to investors. And these major rulebooks, they have one really big thing in common. They require us to use accrual accounting, not cash accounting. Cash accounting recognizes revenue simply when cash changes hands. But accrual accounting dictates that you must recognize revenue only as you actually earn it and record expenses as they are incurred. So the absolute crucial point to remember here is that receiving cash is definitely not the same thing as earning revenue. Let's look at a timeline to visually reveal the massive problem we've accidentally created for Rough Times. Think back. In March, we received $40,000 in promo cash, and we recognized all of it as revenue right then and there. But the actual work, printing and sending out those juicy dog gossip magazines, didn't actually begin until April 1st. Now today is December 31st, our trial balance date. That means we have only actually earned 9 months of that revenue. We still owe our subscribers 3 whole months of unearned magazines that run through to next March 31st.
Uh-oh, we aren't playing by the rules. But hey, don't panic. Here's the adjusting entry fix. We need to reverse 3 months out of the 12 months of that subscription revenue we recorded. Doing the math, that comes out to exactly $10,000. So we debit our subscription revenue to reduce it by $10,000, and we credit a liability account called deferred revenue for $10,000. Now, why is it a liability? Because we still have an outstanding obligation to our readers to deliver those magazines. Once we post this adjustment, we run a brand new adjusted trial balance. And boom, we are officially playing by the rules.
All right, Section 5, generating financial statements. Now we enter the really rewarding phase. We take that newly adjusted, totally rule-abiding trial balance and finally build the external reports that lenders and investors actually care about. First up is the big one, the balance sheet. This document is a direct external reflection of our accounting equation. It gives readers a snapshot of your business's assets, liabilities, and equity at a single exact point in time, usually December 31st. It tells anyone reading it exactly what Rough Times owns and exactly what it owes at the end of the year. It's basically a crystal clear picture of your overall financial health. Next up, we have the income statement. Now, while the balance sheet is a snapshot of a single moment, the income statement is a summary over a period of time. It takes all your business's revenues and subtracts the expenses over the entire previous year. Think of this as your business's report card. It gives readers a glimpse of your actual real-world financial performance and your true profitability. Did you actually make money? This statement will tell you. And finally, the cash flow statement. Remember how we just went through all that trouble of using the accrual method? Well, because of that, the profit you see on your income statement absolutely does not equal the physical cash you actually have sitting in the bank. So this specific statement acts as a separate summary that tracks the real hard cash inflows and outflows over that same period. It shows you exactly where the actual physical money moved. Last but not least, Section 6, closing the books. So the reports are generated, they're sent off to the investors, but guess what? Our job as business owners isn't quite done yet. We need to transition to the absolute final step of the accounting cycle, resetting the system so we can tackle a brand new year. Let's summarize this entire incredible journey we just took. We identified transactions, recorded them in journals, posted them to the ledger, ran a trial balance, adjusted for those tricky accrual rules, and generated our financial statements. The final step is step 6, closing temporary accounts. We post closing entries to clear out our temporary accounts, things like your revenues, expenses, and dividends, straight down to zero. The resulting profit, let's just say it's an awesome $26,440 for Rough Times, is moved permanently into the retained earnings section of your balance sheet. Your temporary accounts are fully reset, and my friend, you are ready for a new year. And there you have it, the whole shebang, the complete accounting cycle. You have identified, recorded, summarized, and analyzed like an absolute pro. So I want to leave you with this final thought. Now that you've mastered the accounting cycle, how will you use these financial statements to measure the success of your next big idea? Because whether you're running a multi-million-dollar dog gossip tabloid or a massive tech startup, the language of business is now yours to speak. Thanks for joining me on this explainer, and I'll catch you in the next one.